All
right, man. I think that we are live. Not exactly sure how many folks that we got on here. I don't think we have any people on here just yet. We're just going live. This is obviously going to be made more for a lot of the followers that I have on Savvy Trader, X, YouTube, all those folks out there. But I think that what I should do first is just introduce who you are. Who's this handsome, dashing man here with me? So Kyle has been a buddy of mine since I was about 17 years old. We've been investing together for, I don't know, a couple years now, 4 or 5 years. And I wanted to bring him on here because I know myself, and I definitely end up rambling sometimes when I talk about a lot of complex topics. So what I wanted to talk about today was actually, so I wanted to answer one investor question that I had, which was going to be, and we'll do this right away, comparing NVIDIA, AMD, and then SMCI or super microcomputer, and talk about the business of each. Then from there, what we'll do is we'll talk a little bit about the stock market being at all-time highs, examine the technicals of the S&P 500, NASDAQ, ARK, Innovation Fund to get an approximation of like what high beta is going to look like, as well as Sky ETF, which I use for a lot of the cloud computing stocks that I have, because I do have a lot of cloud computing stocks. And then what I wanted to do was, Kyle is also going to be making sure that you guys, like, your questions are being seen right away, and then he'll interrupt and make sure that we can hear that, because as I'm on my computer, sometimes it's hard to multitask like that. And then from there, what we'll do is we'll actually talk a little bit about inflation, which is pretty, I think, so there's a lot of noise with inflation, and I see a lot of people talking about like for example, like on Twitter, there's been a lot of observations about like the transportation market, like supply side inflation. But I think that understanding history and understanding where inflation has always come from, and more importantly, how money is created, it can be a pretty complex topic. Like I was talking to Kyle a little bit earlier, that sometimes when you have more complex topics, that there's a lot of subtopics that go on into this overarching topic. So that's what we're going to be talking about here, and really getting an understanding of what inflation, like where inflation even comes from, for one, and how to assess whether that risk is still present in the markets, and then also assessing like what is going to be the thing that can actually take us lower from here and kill our rally away from all-time highs and actually enter into a bear market. So we got a lot of cool stuff to talk about here today. But Kyle, I'm going to give you a second to introduce yourself, man.
What's going on, everybody? My name is Kyle. Like Dillon said, we've been friends for
half a lifetime now.
Yeah, I know. We were just talking. It's been almost half our life, which is crazy. We actually met on a cruise ship, believe it or not, back in whatever 15 years ago or whatever, and been friends ever since. And you know, Dillon, as you guys know, very knowledgeable, very wise guy. For me, my investing journey is more recent, I guess. Like Dillon said, over the past few years, been a roller coaster of emotions in the financial markets. But my background, originally, I'm from Ohio. I went to school to be a pilot, believe it or not, still working on building up my flight hours right now. Moved out to Arizona back in 2016, and I love it here. I mean, as Dillon is probably, negative 10 degrees out, probably in Minnesota. It's 70 degrees out here in Arizona.
It's crazy. There's snow all over the
place. But yeah, that's just a quick little background of me.
Sweet. And then Kyle is going to be here to kind of help facilitate the conversation, because like I mentioned, I know myself. I tend to ramble quite a bit, and he's going to help make sure to analyze that Q&A portion. Also to make sure that you guys are being heard right away.
Yeah, and I'll say, if you guys have any questions, feel free to to comment, and I'll be able to see, should be able to see all the comments. And like Dillon said, I'll try to interrupt to get your questions answered.
All right, man. Let's talk about what I wanted to do is actually talk about SMCI. So this was an investor question, so I'm going to cover this one right away. So super microcomputer was up about 30%, I think, over the past couple days, because they pre-announced their earnings. And what I wanted to do is actually talk about their business model. And I feel like I should actually clarify why I don't own this stock. Sometimes I feel like I should own this stock, But there's obviously a lot of those companies that are out there. Like Celsius is another one that it's like, hey, that fits underneath my category of investing because it's a high growth company, it's profitable. Like, why don't I own this company? Sometimes it's like, this is more from a personal perspective because there's obviously so many positions that I want to hold. But I think that what I'm going to try to do is I'm going to try to provide the most unbiased analysis of this company and provide some perspective on like what they're doing and how they're fitting into NVIDIA's business model as well as AMD's business model. Because Supermicro Computer, what they are is they're actually a hardware company. So if you look at just a brief overview for them for like Yahoo Finance or whatever it might end up being, it actually says it's a semiconductor company, but it's not a semiconductor company. What they do is they provide a lot of this hardware specifically for GPUs. They do have some competitors out in the space, like Dell, I think, does it. Some of the other major players. But what they do is they provide the hardware and the infrastructure necessary to host these GPUs within the data center. That's what SMCI does. And when you saw their recent results, what this is actually more of an indication that the hardware, so like the trends that we saw from NVIDIA back in Q1 and Q2, where they saw that massive acceleration for their H100 GPUs. This is more of an indication that the data center market is still growing at a very strong clip. So I think that NVIDIA ended up hitting like $500 or $600 per share. I'm not 100% sure off the top of my head because it's just been going up every day for past couple months, like a year now. So this is more of an indication, like a leading indicator that this data center market is still growing really rapidly, that there's a lot of investment going into the infrastructure for AI. More importantly, these GPUs. So what does that mean for not only SMCI? So like I mentioned before, that's very, very high overview of what SMCI does. They ended up producing really great results in Q4 of this last year. We'll get a little bit more perspective on their earnings when it does come out about what the forward guidance is going to look like. But I'm sure that AMD, NVIDIA, and SMCI are all going to be pretty tightly correlated. So what does that mean for AMD and NVIDIA? So AMD and NVIDIA are fabless semiconductor companies. So what this means is that they spend a lot of their time actually designing these chips. So when I'm talking about designing chips, so I know that a lot of investors are aware of Taiwan Semiconductor. So think about it like this, that NVIDIA and AMD, they're full of really smart engineers. And these guys spend a lot of their time designing these chips. Once they actually find a design for a chip, like an H100, actually that's more of like a supercomputer, but the chips that go within an H100. Once they find that design, what they do is they actually patent that design. Then they send it to Taiwan Semiconductor or I think it's actually just a fab. I think it's just called a fab, where they actually specialize in manufacturing these chips. And that's essentially what Taiwan Semiconductor does. And AMD and NVIDIA are the two leaders right now as far as when it comes down to like, actually, I think that I need to be sharing this tab. So bear with me here. I know that I'm going to be making some mistakes. I'm still learning StreamYard. This is the software that I'm using. So where was I? So with that, okay, so like I mentioned before, NVIDIA and AMD, they're the market leaders right now as far as the GPU market goes. So when it comes down to NVIDIA, so I'll actually share this. So this is going to be NVIDIA's presentation. Actually, not that one. It's going to be this tab. So NVIDIA, they specialize in, and I can't believe, I still am mad at myself that I did not catch this one at the 2022 market low. So NVIDIA, from a very like high level, top-down perspective, they specialize in data center. They specialize in gaming. So they design the chips for these things. Professional visualization, which is basically like graphics cards. Automotive. So they're actually going to be playing a lot into the EV market right now. So I don't think that they directly compete with Indie Semiconductor, which is another one of my companies, but I have to look a little bit more into that, but I don't believe that they do. And those are the major markets that they are in. And then they also have a software component to their business as well. It looks like that may not actually be on, that's going to be underneath their data center revenue. So essentially with NVIDIA, think about it like this. NVIDIA is the market leader as far as it goes from like a GPU perspective. so they've designed a lot of these AI chips and GPUs. It's like the H100 specifically is not actually just a chip. It's going to be a supercomputer, and it's actually like a big piece of hardware is what it essentially is. And this big piece of hardware is worth like $30,000 to $40,000 or $50,000. And what it does is it actually helps out, helps companies and enterprises specifically, like Meta ended up releasing this not too long ago, train and then also have inferencing, or they can actually run applications on top of these NVIDIA GPUs. They're like their H100s. So AMD is similar. Oh, wait, one more thing about NVIDIA is that they do have that software component like I was talking about. And this is primarily on helping enterprises basically program their AI and develop their AI and also train their AI. So that's what their NVIDIA's software component is really playing a role into. And it's a clear market leader in that market as well. Now, AMD, I'm going to share AMD's PowerPoint. They've been following behind. So they're definitely not a market leader. When Lisa Su ended up taking the company over, or was the CEO, I think, gosh, I cannot remember exactly when she took over the company, but over the past couple years, she's basically been trying to play catch up and creating a new product roadmap for their CPUs and their GPUs. And they originally went after Intel, and then they started actually taking some market share away from Intel in their CPU market. So there's two different types of there's two different types of data center chips. There's going to be CPUs and GPUs, and then the GPUs are essentially what is capable of handling these AI workloads. So NVIDIA does have, and NVIDIA and AMD both have CPU products. But AMD has recently announced it's not their first GPU, but their GPU that does rival NVIDIA's H100. And you can see that best when it comes to, I'll share this tab here. You can see this best underneath this recent price or this, this was on their investor day, not an investor day necessarily, but their product launch of the MI300X. What they ended up doing is, and this was very impressive, and it did not get near enough attention as it should have, because what this essentially did is that AMD came out and they said, "Hey, we have a chip that is comparable to NVIDIA's GPU, and in some cases even better, especially when it comes down to like an inferencing. So, which is the applications that could be ran on top of AMD's GPU. So this is why I own NVIDIA, or not NVIDIA, sorry, AMD, because when I saw NVIDIA start running, the first thing I thought to myself was, okay, I know AMD is currently working on a GPU that is designed to rival NVIDIA. I think that Lisa Su has been playing catch up for many, many years, and they started to catch up to Intel. And then not only that, and I'm not thinking that they're going to take over NVIDIA by any means, but I do think what I've been saying is a lot more along the lines of, like, I know that there's an Azure, and I know that there's an AWS, which means that there's two clear. So, like, let's say NVIDIA is not going to take 100% of the data center market. They may take like 60%, 70%, or 80%. So where does that other 20, 30, 40% go? I'm thinking that other 20, 30, 40% is going to go towards AMD, and I don't think that was necessarily priced in. So those are, do we have any questions at all, Kyle?
No, I don't see any, both on YouTube and here, unless this thing's not working. So just making sure. I should have asked at the very beginning to, well, here, I'll comment just using my page and see if it pops up in here too.
Yeah, I think, okay. Yeah, I can see see you.
Okay.
But it looks like there's no questions at the moment just yet.
Yeah,
that's basically in a nutshell. So, like, when you think about supermicrocomputer, NVIDIA, and AMD all together, they're basically reinventing a lot of these data centers, is what they're not reinventing. They're innovating these data centers for these companies to be able to host AI workloads on their infrastructure. So, like, Meta ended up recently announcing this, and AWS has recently announced it. Microsoft has been a massive investor, especially into reinventing, or I should say, innovating their AWS, or not their AWS, my gosh, their Azure infrastructure. Got so many ticker symbols and stuff like that flying on my mind. But that's basically, so I hope that answers Krishna's comment. I think that he might be here, he might not be there. But if you have any more questions about that, what I'd like to do is actually roll into the market at the moment. So with what ended up happening last week is we actually ended up hitting all-time highs, which was really, I mean, guys, this has been a long time coming. So we haven't hit all-time highs since, what was it, like December?
A year
on
and
the
a half
S&P
ago.
500.
I think it was November of 21.
Yes. Gosh.
If I'm
So
not
that was 2 years ago.
Yeah,
So
or 2.5. Yeah, 2 years ago.
we basically been in a bear market for 2 years. And I think that what's on a lot of investors' minds, and I was just on X before this, and I saw that a lot of technicals, like a technical analysts, are calling for a double top, but I can't see that right now. And the reason why I can't, and this is from a technical perspective, as well as like a macroeconomic perspective. So as it stands here today, so like I think that this should show up okay. When you're looking at the S&P 500, so let's see if I can actually make the screen bigger, because this might actually be pretty hard for people to see. There we go. So is that a better view for you, Kyle?
Yeah, it is.
Okay, it's just the S&P 500. Perfect. So when you look at the technical picture, so like the days, so this is the daily chart on the S&P 500. You can see that it did end up breaking out so we tested it a couple times. We tested it once, tested it twice, and then we broke out last week, which means that there's probably still legs to this rally. The way that I like to look at technicals from a market perspective is that I like to zoom out, because the longer term trends are more important than the shorter term trends. Yes, sometimes we should be looking at the daily trends to get an idea of like what's going to happen on the shorter term basis. But I do think that taking a look at the weekly chart is probably a little bit more important here. So what you can see here is that as we're breaking out on a weekly perspective, that the RSI is still overbought, but we're not necessarily going to be in a downtrend. When you look at the RSI overbought, it can stay overbought for a long time on a weekly trend. And then usually when you start seeing the MACD curl over is typically when you're going to have that bear market start. So we can see in that 2018 timeframe, right here in 2020, the COVID market crash, right here, we started seeing a negative divergence in the markets, which means that MACD has been curling down. So that's that negative divergence, but we're not seeing that negative divergence right now. And then we're also not seeing that curl down just yet. So from a technical perspective, it doesn't necessarily look like that we're ready to pull back in a meaningful way. And then when I also look at the monthly chart, this is pretty important here, is that I actually ended up marking these two parts. Actually, I think that I marked that on the 3-month chart, which is the quarterly chart, and I'll show you that next. So on the monthly chart, we see that the MACD is curled up and we're still not in overbought territory. So yes, we're overbought on a daily and weekly basis, but we're not necessarily going to be overbought on a monthly basis, which tells us that this rally may actually have a little bit more room to go. Like we could see S&P 5,000 sooner than later, but that may be the intra-year high. You know, there's a lot of different factors that are going to go into that, especially from like a valuation perspective. But we're just not there yet. From a technical perspective, I'm not seeing it, especially when you see the 3-month, which is the quarterly chart. Right here, what I ended up doing, and I posted this on Savvy Trader. So every single time you can see this black line, this is when the MACD curled up above so like the MACD curled up on a quarterly basis. So the last time this ended up happening, so this was during the secular bear market of 2000 to 2012. The last time that happened was in 2004, where the S&P continued to rally for another couple of years, like 3 years. Same thing ended up happening in 2011, where the S&P 500 ended up rallying. I think that the first 20% correction was in 2018 and in 2020. And then obviously we saw a curl down right here, and then now we're curled back above. Are we going to rally for another couple of years? I think that really has a lot more to do with the macro. The NASDAQ is showing similar things. So I'll throw on the RSI and the MACD on this. And this is predominantly going to be tech. So like I follow the NASDAQ quite a bit. And you can see that the daily RSI actually curled up above. And we broke out from where we recently were. So let's see if I can zoom out a little bit. So the NASDAQ ended up breaking out, and it's probably gonna reach the NASDAQ composite is probably gonna get to 16,000 is what it's looking like. 1570, 75, or 16,000 is probably where it's gonna be at before it actually pulls back. So we could see a pretty solid uptrend for the next couple, let's say, 2 or 3 weeks. That's what the technicals are pointing towards, because we're breaking out, we're moving higher. But we're pretty disconnected from the 200-week moving average and the 200-day moving average. Typically,
Hey,
yes.
I just want to say it on the screen. It's still showing the S&P.
Thank you.
So,
that's why you're here, man. That's why you're
Yep.
here. All right. So you can see the NASDAQ broke out from this part right, or this little consolidation, and it's looking like it wants to go up to that 16,000 point. Thank you, Kyle. I appreciate you doing that.
Yeah.
The weekly chart, it's going to look about the same as the S&P 500 here. Yes, it is overbought, but we can stay overbought for quite some time. So like for perspective, back in the 2017 timeframe, they stayed overbought. This 2017, 2018 market, this stayed overbought for about a year before it finally ended up pulling back. And in the beginning of 2018, that was only 2 10% corrections before it made a new all-time high. Before that vicious, I don't want to call it a bear market, but it was like a vicious correction at the back half of 2018. We're seeing something similar like that right now, where the MACD is curling up, which means that we're back in an uptrend. And I do think that we're going to head back to retest NASDAQ all-time highs, which is something I've been dreaming about for like 2 years now. So the Sky Innovation ETF is what I use as a proxy for software stocks. And it looks like I actually successfully transfer this one over at the moment. So software stocks showing a similar picture here as the S&P 500 and the NASDAQ, where we're breaking out. So I got to put down the MACD on here too. Same thing, right? We got the MACD curling up. Yes, we were overbought on a daily basis, but we did break out from this consolidation phase, and we're likely going to go back to this 94, 95 area. And I know that this is just an ETF, but when you think about it from like an algorithmic perspective, that the algos and the quants, what they do is they look at like a very, I don't know, like a bird's eye view, and then they look down from there. So they see these things breaking out, and then the algorithms do care about this, because when there's those pockets of supply, that's usually areas where traders pile in, funds pile in, and things like that. I mean, but we're definitely in an uptrend. And even from a weekly and a monthly basis, I think that the monthly was probably one of the most interesting ones for me, for like the Sky ETF, is that you actually see the MACD curling up over here. And that was, so I think that I ended up seeing this, and this is about the time where I started my Savvy Trader portfolio. So this was when I started noticing that the Sky Innovation ETF was very, very oversold. And this is going to be right here in this January timeframe, January 2023. I was like, oh, I'm pretty sure the markets are at bottom, because you can see this aggressive selling, and now we're actually heading a little bit more into a normalization phase, where if you drew a trend line, this was the previous trend for cloud stocks prior to the 2022 bear market. So there was an opportunity zone right here where what I believe that a lot of us ended up taking advantage of, especially a lot of folks who ended up following me. And for a high beta proxy, it's the craziest thing to me, how important ARK Innovation ETF is as a high beta proxy, because when you look at a lot of the higher beta portfolios, like small cap portfolios, or a lot of people who take a lot of risk, like in biotech or whatever it might end up being, or even in small caps, the correlation and the similarities between ARK Innovation ETF and the higher beta stocks is just unbelievable. Which I think that the algos treat ARK as that high beta ETF, and that's exactly where I get an understanding of, like, is my portfolio going to rally? Because I do have a lot of higher beta stocks like Indie Semiconductor, Shift4, Navitas. Those companies are going to be riskier companies, and I'm aware of that. And essentially, a lot of the time, like in a shorter time frame, the markets that a lot of these stocks are in don't trade on fundamentals. They trade on what would be perceived as like technicals, or like there's a lot of money rotation going on here. And when you look at ARK, it does look a lot like Sky Innovation ETF.
I have a question with Dillon.
Yes.
So when you talk about the technicals, what would you say the most important part of the technicals is when you look at these trends?
So it's a picture, which means that there's a lot of details in the picture. I think that a lot of technical analysts, they tend to overemphasize patterns or VWAPs or moving averages, but it's what I mean by it being a picture is it's like you can't just look at one thing. You can't look at just the RSI. You can't look at just the MACD. You can't look at just the technical setup, which, this could be considered as like a bull flag or whatever. You can't look at just that. It really is like understanding what the whole chart is telling you, and then actually being able to get an idea of what the picture is telling you. So when you do see time frames where everything is oversold, so I think I actually ended up calling a bottom. Let's go back to the NASDAQ here. When I saw that the weekly chart hit oversold territories was one of the times that I said we're probably near a bottom, was that May and June timeframe. From there, we bounced off the 200-week moving average, but look at everything that was going on at around that time. We hit oversold on the RSI, then we hit a higher oversold on the RSI, which you saw a positive divergence end up happening. And when I saw this going on in October and in January, where we saw two different bottoms, right there in October, right here in January, when I saw that there was a double bottom with a positive divergence on the RSI and a positive divergence on the MACD, that gave me the confidence from like assessing what I know about macroeconomics. So it gave me the confidence to like combine them, right? Because the way that I look at the markets is not just technicals. It's not just macro. It's not just fundamentals either. It's everything all together. So you understand that inflation was falling, that valuations were low. You see a positive divergence on the RSI, and you see a positive divergence on the MACD. The thing that registered in my mind was it's probably time to post an article on Substack that says all-time highs are coming, which I did do in November 14th of 2022 when I said all-time highs are coming. So that's the best way to think about technicals is like, it's like, what are the current trends saying? What are the divergences that are happening? What are the patterns that are happening? And I think that a pattern that recently ended up happening not too long ago was actually going to be on the S&P 500. So let's go back to the S&P 500. When we saw this head and shoulders pattern, so we can draw this out here. This is how I knew that we were going to head into a market correction, because I saw the head and shoulders. I can't remember exactly where to find this. So anyway, it's not a big deal. So I saw the head and shoulders. Here's one. That's the head. So this is the left shoulder, the head, and the right shoulder. Once you saw that happen, then it's like, okay, if this breaks below this part right here, which is basically the neckline is what they call it, that the S&P 500 is likely going to go back down to at least its 200-day moving average, which it did. It bounced and it tried to test that zone again, and it went lower. And that was about the moment where I'm like, yep, probably bottom. And the reason why I said bottom is RSI oversold here, boom. RSI oversold here, boom. So that was basically, but it didn't go lower. The RSI was about the same. So I don't consider that necessarily as a positive divergence, but then you think about like, okay, what's the macro picture look like? Like, does this justify a 20% decline, or are we a little overbought right now where we probably just need to get a correction? And that was my assessment on the October market. So, and also inflation was falling. The Fed was probably going to start easing rates. So like you just put all that stuff together. Does that make sense?
Yeah, that makes sense.
Okay. Thanks.
Yeah, so another, it's just like you can't just look at technicals, or you can't just look at fundamentals. You have to, like you said, put a big picture to combine everything that kind of, in a sense, draws out the future of where the markets are going.
Yes. So think about it like this. there's three different tools that we can really use as investors: technicals, macro, and fundamentals. Technicals are what we're covering right now. The other 1/3 of that equation is going to be the macroeconomic pictures. That's like central banking 101, and like how liquidity actually affects the markets. And what I mean by liquidity is I'm talking about whether or not the Fed is easing or printing money, or are they restrictive monetary policy or easing monetary policy. And fundamentals being the valuations of individual companies, and then also this is a lot more of like the qualitative analysis, not quant analysis. So quant is like I mentioned before, the bird's eye view. Qualitative analysis is like a bottoms up approach, where you can take a look at the individual companies within the ETFs, and you can say, so like during this time in October, that's when I really started buying. I actually bought on this part right here when I started buying quite a bit. I mean, I was like buying heavily. And during this little downtrend right here, because I started looking at the valuations of individual companies and I knew the macro picture, I was like, inflation's falling, Fed's going to start easing rates, valuations are cheap, time to buy. And I also looked at from the technical picture, I saw A wave down, B wave up, C. So actually, if you think about it from like an Elliott wave analysis, this is the way that the Elliott waves actually ended up. So I never talk about Elliott waves because it's pretty complex, but you basically have wave 1, wave 2, wave 3, wave 4, and then you had wave 5. Typically, markets bottom on 5th or 3rd waves. So I thought that they might bottom here, which is why I bought here. So that was a 1, 2, 3 wave down. And then I saw this and I saw it rejected. I'm like, okay, we got to make a 5th wave. Once we saw that 5th wave and the RSI get oversold, then it was like, it's probably time to start rallying right here. I don't think that we're going to reach that 200-week moving average. And then I can even put that right here. During this was actually a bear market in itself. This is wave 1, wave 2, wave 3, wave 4, and then wave 5, which means that this is a complete pattern. That tells me that during this time, RSI oversold. We saw positive divergence on the RSI. We completed a 5-wave pattern, probably a market bottom. That's the way that I really look at that. And that's for a whole different topic there. So it's really just combining everything and using a lot of different strategies to really get a good understanding of what the markets are going to look like. Does that answer your question at all, Kyle, or what?
Oh, yes. Yep.
Okay.
Yeah, that makes
those are really great questions, by the way. Thank you for asking those. So I think that the question really becomes, let's go back to the S&P 500. What is going to be the thing that is going to crash the markets? And I got to actually clean up my tabs here for just a second. And what I'm going to do is I'm going to go to something that I ended up pulling up on my last chart. Or not my last chart, my last live stream. And that's going to be the 10-year, 2-year spread from the Federal Reserve website. And when we look at this spread, this is a very, 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 very important spread. So,
hello, Krishna.
Hey, Krishna, what's going on? Hey, I covered Krishna. I covered the AMD, NVIDIA, and SMCI at the beginning part of this. So if you didn't see that, it's going to be on a replay. So with the 2-10-year yield spread, like it's the reason why I like looking at this chart is because it cuts out of all the bullshit. Excuse my language. I hope that I don't get flagged for that one, but it is because a lot of these macro investors, like I really do wonder about them. And the reason why is that it's like you have these very clear indicators of when we're going to be in a recession, when we're not going to be in a recession, such as like jobless claims. So if jobless claims are below 2 million, like we're probably not in a recession. Not only that, but then the 10-year, 2-year yield spread. This has historically been the most accurate predictor of recessions. But if you notice, for the gray area is going to be that recessionary time frame. If you notice, the yield spread steepens right before the recession, which means that it's uninverted and it's steepening right before the recession, which basically sends an indicator to the financial markets that something is very wrong in the economy and the Fed is about to aggressively cut rates. That's what that means. So, Kyle, I want to make sure I stop here. How are you thinking about this? Like when I say those things, because macro can be pretty complex.
Yeah, no, I feel like it's in a sense similar to what you were saying about my question about like when you're looking at technicals, what exactly you look at. It's more so these graphs are telling a picture that not that you could necessarily pinpoint predict exactly when something is going to happen, but the the picture is showing you signs of something has to change in a sense.
Yes.
And and that's where, like you said, in this specific graph, you're noticing certain patterns where now, like you said, the Fed has to aggressively, in a sense, respond to what's going on. So
Yes, and the bond market sees it first. So this is basically analyzing the bond market. So the bond market is going to be like the bond market is the dog and the stock market is the tail. So and the dog does wag the tail, meaning that the stock market responds to the bond market. So when you look at what's going on in the bond market and you can understand what yields are saying, more importantly, like when you can understand what yields are predicting from a Fed cut perspective, and this is really cool, man. I can really show some cool stuff here. So when you let's go 10-year yield. So when you look at the market yields over time, and I'll even show you guys what I'm working on here real quick. And this is kind of an impromptu. So when you look at the 10-year yield, when you look at the 2-year yield, and you even look at the 3-month yield, so the 3-month yield, what ends up happening is you see that rates follow a very clear pattern. So you can see that the green one's going to be the 3-month yield, the red one's the 2-year yield, and then the blue one is going to be the 10-year yield. So you can see during times where the yield curve actually uninverts. So basically at the back half of 2018, or it does invert, right here in 2006 and 2007. But when you look at the green line and the red line, look at how the squigglies respond to that recessionary climate. Or this one right here during COVID. Look how they respond and how they fall off a cliff. Same thing right here. The 3-month and the 2-year yield led the 10-year yield down and actually went down further, which means that the yield curve was very steep. This is typically going to be an indicator of a very strong, promising future economy because yields are accommodative. The Fed has not started their tightening cycle yet. Inflation is usually relatively low during this time period, which is probably the best time period for bonds. Or not bonds, sorry, stocks. So you can see that's essentially, so like I look at the bond market to get an understanding of what the economy is going through. So if we go back to the yield curve and what I was talking about before with the macro bears constantly calling a recession, like what's going to kill this all-time high, right? I'm thinking that we're going to continue to rally all the way up until the yield curve for one uninverts. So we have to see the yield curve uninvert, have to. And the reason why is that that's going to be the bond market signaling to us danger, danger, short-term economic headwinds on the way. And then the Fed they're too slow right now. So like the Fed has never, ever throughout history been able to successfully uninvert the yield curve and avoid a recession because they're doing the same thing like what they're doing right now. They're basically pussyfooting around and saying, I'm not sure, like, what about inflation, yada, 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 but and you can actually even add on CPI inflation here. So like, what about inflation, yada, yada, yada. And they're so worried about inflation that they do torpedo us towards a deflationary event. And I can actually fix this right here and just do the price change. Okay. And you can see that during these deflationary events, so like recession, you can see inflation high here. So like this is the yield curve, remember. I don't like how I can't this creates a lot of noise on the chart. So we got the yield curve inversion right here. Inflation's high. Inflation's still high. Inflation's still high. And then as soon as the yield curve starts to steepen, inflation peaks, comes down immediately. because inflation always comes down during recessionary time periods. So the answer to the question of what's going to kill this rally is that, number one, it's going to be a deflationary event. Because inflation isn't going to happen. We can talk about that probably in another video, because this is going a lot longer than I thought it was going to go. And I had my anniversary dinner tonight, so I got to get ready for that. My wife and I have been married for 2 years, so it's kind of cool. But
happy anniversary, by the way.
Thanks, man. Thanks. But the deflationary event is going to be what essentially kills this bull market rally. And the deflationary event isn't going to happen until the yield curve signals it to us. So a lot of people are super early. So like Peru, Kyle, I'm not sure if you remember Peru. Peru has been talking about deflation every day for the past year. Eventually he's going to be right. Maybe next year though, it may not be this year. So he's going to be basically sold out of all of his stocks, miss an entire rally, and then finally start reinvesting back into the market, after he gets all of his confirmation. But he missed out on all the gains that happened along the way. So we have to watch out for like what's going on with the yield curve on inversion, because once it does on invert, that means that there's danger ahead in the economy, that we're probably going to actually start heading towards a deflationary event where unemployment does start rising. And I'm not 100% sold on the idea of stickier inflation either. And the reason why is probably going to be saved for next time. But I wanted, I'm gonna do that. I'm gonna do a cliffhanger because this video is getting long. We're about 40, almost 45 minutes. So I'm gonna do that, and I'll stop sharing I'll stop sharing this. But for next time, we'll cover inflation, the reasons why inflation happens, and from like a historical perspective, like what we can learn from history and the 1920s. So that 1917 to 1920, 1945 to 1956. 1970, and now this inflationary episode. And we can even talk about the 2008 inflationary time period. That's what we'll talk about next time, and what we can learn from the past, and then also go into central banking and how money is created in the first place, and why inflation happens because money is created too fast. But do you guys have any other questions? Leave some comments down there. Kyle, do you have anything?
No, I think this was just very knowledgeable presentation, just going over the markets, where you believe they're heading and why you believe, because I think it's important to understand the reasons why, not just I know a lot of people just follow people off of X or Twitter or whatever to get those answers, but a lot of people don't understand the reasons why the markets are moving in certain directions and whatnot. So I think it's very good to have someone as knowledgeable as Dillon here to be able to explain, because it's and I know some things get very complicated, but it, like, again, like I do believe that lives like these help, because then it gives people at the same time opportunities to ask questions that may come across your mind. But yeah, I don't have any specific questions, no.
Hi, Viviana.
What's up, Viviana?
So we'll talk about that next Sunday probably. But you guys can always follow my Savvy Trader account. Kyle has a huge TikTok presence. You can always follow him on there, where he does a lot of photography and pilot stuff. But you guys can always follow my Savvy Trader. If you don't already follow my Savvy Trader, it's in the link down below. And yeah, until next time, you guys can always follow my portfolio, all the moves I'm doing, my buys. You can receive buy and sell alerts, everything from top to bottom. You can see exactly what I'm doing when I start raising cash, when I start investing, and I'll even provide detailed analysis on like why I'm doing these things, because the most important thing at the end of the day is actually making a difference in people's lives. It's not about views, clicks, likes. I don't give a shit. What I really give a shit about is actually making a difference in somebody's life. And then hopefully that you can spread the knowledge so that people can continue to take control of their own financial future and achieve their own financial goals longer term. And there's a lot of things along the way that I'd like to share. So probably until next week, though, I'll do another live stream next Sunday. I might do a video. I might not do a video. I'm not 100% sure in this next week, but you can always follow me and get a hold of me on Savvy Trader, as well as on X, or just the comments down below. Thanks, everyone, for coming. Appreciate all you guys. And until next week, have a good one.